Imagine you are at a buffet at which you can choose a single dish or get a plate with a little bit of everything. Which option would you like? If you are like me, you will select option 2 because it has a greater flavor and variety. It is quite similar to how exchange-traded funds, or ETFs, function. They are bundles of securities that let you invest in a whole market or sector with a single transaction. Stay tuned as we go into great detail about the exchange of traded funds. For more videos like this, don't forget to click the likes and subscribe buttons on our channel. Exchange-traded funds, or ETFs, are some of the most popular investing choices among retail and institutional investors alike. Investors have access to low-cost options for trading, arbitrage, and diversification through ETFs. They are usually touted as superior and more affordable than mutual funds. We will first examine how ETFs have changed over time. ETFs were created when the index investment craze began to take off. The idea of indexing investments has existed for a while. Periodically, closed-end funds and trusts have been created with the intention of letting clients invest in a particular asset class. Meanwhile, none of these resembled what we now know as exchange-traded funds. As a result of academic research that highlighted the advantages of passive investing, Wells Fargo and American National Bank both created index mutual funds for institutional investors in 1973. A few years later, on December 31, 1975, mutual fund pioneer John Bogle unveiled the first open-ended index mutual fund. With just $11 million in assets at launch, the first index investment trust tracked the S&P 500. When Bogle passed away in 2019, the fund's holdings, which are frequently disparaged as Bogle's folly, totaled $441 billion. The fund is now known as the Vanguard 500 Index Fund. The race went on to make ETFs more accessible to the investing public as it became clear that the investing community had a desire for these indexed funds. This is because mutual funds tend to be pricey, complex, illiquid, and many mandated minimum investment amounts. According to Gary Gastineau, author of the Exchange Traded Funds Manual, index participation shares for the S&P 500 were the first substantial attempt at something like an ETF when they were introduced in 1989. Unfortunately, despite strong investor interest, a federal court in Chicago determined that the fund functioned similarly to futures contracts. As a result, if they were to be traded, they would have to do so on a futures exchange, which would postpone the creation of true ETFs. The Toronto Stock Exchange introduced Toronto 35 Index Participation Unit STIPS 35, the second attempt at the modern exchange-traded fund, in 1990. This is a C35 index tracking tool based on warehouse receipts. Exchange-traded funds ETFs allow investors to pull their money into a pool to be invested in stocks, bonds and other assets by investment companies. In exchange for the investment of their money, investors receive an interest. These ETFs are usually registered by government regulatory authorities. Many investors in ETFs can be assured that their funds will be professionally managed by advisors who are certified and registered by government regulators. Some ETFs simply seek to replicate a specific market index's returns, usually known as index funds. In contrast, other types of ETFs are actively managed ones which typically buy and sell stocks, consistent with their investment targets. Mutual funds are not equivalent to ETFs, although they are similar to mutual funds that can be bought or sold by end-of day at their net asset value per share. ETFs also allow trading opportunities throughout the day via national securities exchanges, where one can take advantage of current market prices. Types of exchange-traded fund. Investors who wish to generate income or speculate on price increases may find it useful to invest in one of the various types of ETFs available, which also helps them manage risk. Here is a concise description of a few available ETFs on the market. Index-based ETFs. Most of the available options for exchange-traded funds follow an index, and the primary objective of these ETFs is to mimic a securities index such as the S&P 500 stock indicator while primarily investing in its component securities. The investment strategy of SPDR or SPDR ETF is to seek out and invest in every possible equity security available within S&P 500 stock index. ETFs may choose to display their investment holdings on their website every day. Actively managed ETFs. The non-reliance on indices distinguishes actively managed ETFs from their passive counterparts. Instead, they strive for a given investment objective via allocating investments across varied asset classes such as stocks, bonds, etc. Advisors managing actively managed ETFs can freely buy or sell their holdings components every day without adhering to a specific market. Index bond ETFs. Regular income is what bond ETFs are designed to offer to investors, and the performance of underlying bonds plays a large role in determining their income distribution. Bond investments can include a combination of both corporate debt securities like government-issued securities referred to as municipal or state/local bonds, while bond ETFs lack an expiration date which is present in their underlying securities. It is common for them to be traded either above or below the actual bond price. Stock ETFs, tracking a particular industry or sector using shares to create an investment vehicle, is the concept behind stock ETFs. For example, a stock exchange-traded fund might follow foreign or vehicle industries. The aim is to have diversified exposure in an industry that includes high-performing companies as well as new entrants with potential for growth. Industry/sector ETFs. Sector and industry-focused ETFs pool investor money together into a single fund and invest the fund in a specific sector. Energy sector ETFs focused on industries that aim to capitalize on the growth potential of a specific sector by following how companies operating within it perform. The tech space offers an illustration of where there has been a rise in investment in recent years, and direct ownership of securities results in greater exposure to downside risks from market volatility, which is mitigated by investing in ETFs. Industry ETFs can also be used for sector rotation during economic cycles. Commodity ETFs. Commodities such as gold and crude oil are invested in by commodity ETFs based on what their name suggests. Investors can benefit from several perks when investing in commodity ETFs. By diversifying a portfolio first, they can more easily hedge against downturns. If you're looking for a way to buffer any losses during declining markets, consider trading commodity ETFs. Additionally, it is cheaper to hold shares in a commodity ETF compared to possessing the actual commodity. The absence of insurance and storage fees make the former a more economical choice. Currency ETFs. The combination of domestic and foreign currencies in a pooled investment vehicle is what makes up a currency ETF that tracks the performance of specific currency pairs. Additionally, a single currency ETF can fulfill multiple objectives. To speculate the price of currencies of a country, you can use them based on its political and economic developments. Utilization as a hedge to counteract the instability of foreign exchange markets by importers and exporters is another use case for them. Likewise, those which act as a hedge against inflationary pressures and an investment in Bitcoin can be made with the help of the offered ETF option. Inverse ETFs. Profiting from the decline of stocks is what inverse ETFs aim for through their strategy of selling short. This involves short selling, which is when investors sell stocks they don't own, hoping the stock will lose value so they can buy it back later for less. Inverse ETFs employ derivatives to enable the shorting of stocks, and it can be said that they are simply speculations for a decrease in the market. Leveraged ETFs. A leveraged ETF employs leverage in an attempt to exceed the returns generated by its underlying investments. An investor who invests in an S&P index with leverage of twice their initial investment would see their funds grow or reduce twice as fast when compared to non-leveraged funds. Options or futures contracts are utilized by these products to magnify their returns through leverage. Furthermore, there are leveraged inverse ETFs which try to achieve an amplified opposite performance. Advantages of exchange-traded fund. Investors' preference for exchange-traded funds is attributed by its minimal complexity and lower costs along with wider access options. Here are some of the upsides. Diversification. ETF investing allows investors to spread their risk by diversifying across multiple industries and sectors. Diversifying your assets can help lessen the impact of changes in the stock market. Investing in companies of varying sizes within different industries and location can help you achieve a more balanced investment portfolio. Transparency. With internet access, one can easily search for and find out about the price of particular ETFs traded on exchanges. Additionally, daily disclosures of a fund's holdings can be seen by anyone, while these details for mutual funds can only be made available on a monthly or quarterly basis. Tax benefits. ETFs have a tax advantage over mutual funds. Throughout your investment in a mutual fund, you will need to pay capital gains tax on profits from asset sales like stocks. ETFs have lower trading costs compared to actively managed mutual funds because the latter tend to trade assets more often. In contrast to mutual funds, which are taxed annually on capital gains distributions, you can expect to pay lower taxes on your investments when you choose to invest in ETFs. Disadvantages of exchange-traded fund. Some investors find exchange-traded funds useful despite the fact that there are imperfections. Presented here are the downsides. Trading costs. Be aware that you can incur other charges related to owning an ETF besides its expense ratio. When you buy and sell ETFs through an online broker, they might charge you a commission fee due to them being exchange-traded fund. Although a growing number of providers have waived their fees on ETF trading, not everyone has adopted this policy. Potential liquidity issues. Selling any security is dictated by the ongoing market price trends, but it becomes more challenging in the case of illiquid ETFs. Risk of closure. Inadequate assets can lead to failure to cover up the costs involved in administration. A shuttered ETF can be inconvenient because it may force investors to sell earlier than intended and possibly at a financial loss. If you enjoy this video, give it thumbs up and share it with your friends so that we can keep making them. For more videos like this, hit the subscribe button and remember to click on the notification bell so that you get notified when we post a new video. Thanks for watching.